In today's video, we're breaking down a fresh Dan Ives segment where he addresses what a lot of investors have been feeling lately, a weak December, lingering valuation worries around the AI trade, and the pressure that's been showing up across mega-cap tech. But even with all of that noise, Dan Ives is still staying bullish on Microsoft, and he backs it up with a key point that really changes the way you look at this cycle. He says only 3% of US companies have started the AI path. And if that's true, then we're not late in the AI story at all. We're still early, and the next phase could be bigger than most people are pricing in. First, I'm going to play the clip so you can hear exactly what Dan Ives said in his own words. Right after that, I'm coming back with my detailed reaction and breakdown. After that, I'm going to share 3 energy growth stocks to buy now, because as AI adoption scales, power demand, data center expansion and grid investment become the quiet backbone behind the entire AI build-out. Hit the like button, let's get 1,000 likes on this one, share the video and drop your thoughts in the comments as we go, and if you're new here, subscribe so you don't miss the next important financial investing update. Now, let's hear what Dan Ives has to say.
You say investors are underestimating Microsoft and Azure growth. What are we not seeing that you're seeing right now?
I think, look, the last month we've seen 25–30% of the deals accelerated. I mean, you're seeing these use cases explode. I think we go into January when they report the quarter, and I think as the forecasts continue to move higher, look, I think the stock has a 6 in front of it, as we go into 2026. That's really the call here. This is a table pounder, in my opinion, especially on hyperscaler. Investors give it no respect. It's almost the Rodney Dangerfield of software, the way they're treating it.
I love the analogies as always, Dan, the Rodney Dangerfield. I do want to talk about valuations. That seems to be one of the things really pressuring the tech trade. Also some concerns about the AI build-out. Are you saying Microsoft is immune to those concerns?
Look, I get the concerns, Frank, but I mean, the reality is all of our checks are showing, demand and supply is 12-1, when it comes to Nvidia chips. The hyperscale build-out, only 3% of US companies have gone down the AI path. I think when it looks to valuation, I think investors are underestimating the growth. I think street numbers are underestimated here anywhere from 15 to 20% for 2026. And that's really the call as it plays out. I get the white knuckle moments now, and the bears sort of winning the last few weeks. They're not going to win next year. I think tech stocks are up 20–25% in 2026.
All right. So it's kind of interesting that you're very bullish on Azure, but also the Copilot business. Have you seen these reports related to Salesforce where they're kind of telling people, Agentforce, it may actually work better if you don't use Gen AI? Is that a concern that we're starting to see companies maybe not seeing the results from AI that they thought they would initially, and whether or not it's a long-term narrative, we don't know yet. That's a longer-term story. But in the short term, could that possibly shake investor confidence in the AI trade, specifically when we're looking at companies like Microsoft?
Yeah, it's a great question. Look, I get that with a name like Palantir. Those customers' ROI is way accelerated ahead of what they ever expected. So I think it depends on the use cases when it comes to what we're seeing with Salesforce, Mongo, Snowflake. Look, it's an arms race playing out, and you're going to need to see certain customers see the ROI. We talk about 2026 has to be the year of monetization when it comes to AI, and I think we're going to see that, and I think that's why it takes the next step, besides obviously names like robotics, autonomous, and true, right? I think AI coming to the consumer.
All right. I don't know if you saw over the weekend, Bernstein saying that Nvidia is the cheapest it's been in a while and that at 25 times forward earnings, it's a pretty good deal right now. Do you agree with that take, that the fact that the place we're seeing Nvidia at right now with the bullishness that you have, this is a bargain right now?
250 to 275 is what I see for Nvidia. Frank, look, there's one chip in the world fueling the AI revolution. It's led by the godfather of AI, Jensen, right? And I think what we see here, investors, you're not even factoring in what's going to happen in the China market as they get further into that, and that's our expectations. But look, they're playing a different game. They're 4 to 5 years ahead of anyone else in the market, and that's why I think this is a stock that's going to have a massive 2026, and numbers are going to dictate it. And I think anytime you see sell-offs in this, golden buying opportunities, in our opinion.
All right. What about the index play? Is this more of a stock pickers year coming up in 2026, or is it more about trying to play the indexes, whether it be the triple Qs or some of these other really tech-focused ETFs?
Yeah, look, overall, I think it's going to be a great year for tech because the second, third, fourth derivatives are playing out across AI. But I do think it's a winners, losers. I think you have to focus. It is more of a stock pickers market, specifically who do you own in software? Who do you own in semis? You look at Micron, SanDisk, some of the memory players. What about the infrastructure, Nebius and some other names? So look, Frank, I do think we talk about in our Ives AI 30, like that's a core part of our thesis. It's not just owning the sector. You got to own the ultimate winners and you got to do the work. You can't see AI from the spreadsheets, as we always say. And that's why, always on the road in Asia and around the world trying to figure out who the winners are.
All right, so you just watched Dan Ives come on and essentially make the case that a lot of investors are misreading what is happening inside big tech right now, and especially inside Microsoft. The whole interview is him pushing back against the idea that the AI trade is tired, the valuations are stretched, and the build-out is starting to wobble. His message is basically, you might be looking at the noise on the surface, but under the hood, the demand signals are getting stronger, not weaker, and the market is still underestimating how big the next leg could be going into 2026. When Dan says investors are underestimating Microsoft and Azure growth, he is not talking in vague hype terms. He is pointing straight to deal activity and adoption. He talks about how in the last month they have seen deals accelerating at a dramatic rate, and he frames it as use cases exploding. The specific number in the transcript sounds exaggerated or garbled, but the point he is trying to land is clear. He believes momentum is accelerating, not slowing. In other words, the pipeline is not just healthy, it is speeding up. Then he zooms in on the timing catalyst. He references January, when Microsoft reports the quarter, and he is implying that the market is going to be forced to reprice Microsoft if Azure growth and AI-related monetization show up in the numbers. He also throws in that comment about forecasts continuing to move higher. This is important, because in his view, it is not just about a good quarter, it is about the street having to adjust forward expectations. That is why he keeps pulling it toward 2026. He is saying if the market is still treating Microsoft like a mature, slow-growth megacap just because the stock already has a big number in front of it, then the market is missing what Azure plus AI can do to the growth profile over the next year or two. And that is where the table pounder language comes in. Dan is basically saying this is not a cautious buy rating, this is one of his highest conviction ideas. He takes it a step further with the Rodney Dangerfield analogy, basically saying, Microsoft is not getting respect. That is interesting, because most people think Microsoft is one of the most respected names on the market, but he is not talking about general respect. He is talking about respect for upside. He is saying the market is still not assigning enough credit to how central Microsoft is becoming in enterprise AI, especially through Azure, and what sits on top of Azure. Then the interviewer presses him on the two big pressure points that have been hanging over tech, valuation risk and AI build-out concerns. A lot of investors have been saying, tech is priced for perfection, and if the AI spend slows, the whole narrative could crack. Dan's response is basically, I understand the fear, but our checks are showing the opposite. He uses a very simple supply and demand argument. He says demand to supply is 12-1 when it comes to Nvidia chips. That is his way of saying, the constraint is still capacity, not demand. In other words, companies want the compute, they want the GPUs, they want to run these models, but supply is not keeping up. That kind of statement matters because it reframes the risk. If demand is still massively outstripping supply, then the AI build-out is not some temporary bubble in his mind. It is a multi-year infrastructure cycle, and the biggest players are still fighting for resources. He also drops a statistic that only 3% of US companies have gone down the AI path. Whether that exact figure is perfect or not, the argument is the runway is enormous. If only a small slice of companies have meaningfully implemented AI, then we are early. That is his core theme. Not late cycle, early innings. And if you accept that framing, it changes how you interpret valuations. Because valuation only looks expensive if you assume growth is about to slow. If growth is about to accelerate, then today's multiple can look reasonable in hindsight. That leads into his point about street numbers being underestimated. He is basically saying analysts and consensus estimates are too conservative, and that investors are not pricing in the real growth potential. He talks about 2026 growth being underestimated by 15 to 20%. Again, the key is not the exact phrasing, it is the direction. He's saying expectations are too low relative to what he thinks is coming, so the re-rating could happen as estimates rise. And then he goes into that emotional market psychology language. He talks about white-knuckle moments, bears winning the last few weeks, and then he basically predicts they are not going to win next year. The transcript has a line that sounds like, tech stocks are up 2,025% in 2026, which obviously reads like a transcription issue, but the intent is consistent with what he usually argues. He is talking about a strong year for tech, something like 20 to 25%, not 2,000%. The takeaway is, he thinks the pullbacks and valuation anxiety are temporary, and that fundamentals will reassert themselves in 2026. Then the conversation pivots to something a lot of people are quietly worried about, which is ROI. It is one thing to say, AI is transformative. It is another thing to prove it is paying off for customers. The interviewer brings up those reports around Salesforce and the idea that certain agent-style workflows may work better without generative AI in some cases. That question is really asking, are we hitting the reality phase where companies realize AI is not magic, implementation is hard, and the payoff might not match the hype in the short term? Dan's answer is nuanced, in a very specific way. He basically says, it depends on the use cases. That is a key line. Because this is the part of the AI cycle that a lot of investors miss. Not every AI product is equally valuable. Not every deployment creates savings. Not every company will execute well. There are going to be mismatches between what is promised and what is delivered. So when he says it depends on use cases, he is acknowledging that some implementations can disappoint. And that could create headlines, and headlines can shake confidence. But then he immediately counters with examples where ROI is exceeding expectations. He mentions Palantir customers seeing ROI accelerate ahead of what they expected. Whether you love or hate Palantir, he is using it as a proof point that in certain environments, AI and data platforms can create measurable value fast. The implication is, if the use case is right, and the deployment is disciplined, the payoff can come quicker than the market expects. He also frames this as an arms race. That is important because in an arms race, everybody is moving, even if some of them are inefficient. Salesforce, MongoDB, Snowflake, Microsoft, all these platforms are trying to become the layer where enterprises build AI workflows. Dan is basically saying, yes, some customers will hesitate until they see proof, but the direction is not reversing. Enterprises are not going to opt out of AI. They are going to demand results, and they will shift spend toward the vendors that produce those results. That is why he says 2026 has to be the year of monetization. This is a very investor-friendly phrase because it separates experimentation from profit. Early on, companies spend money to build infrastructure and test products. Later, companies turn that into recurring revenue and margin expansion. He is saying we are approaching the point where the market will stop rewarding AI stories and start rewarding AI dollars. That means, who is actually converting AI demand into revenue, bookings, and earnings? He also hints at what he thinks is next beyond the current phase. He references areas like robotics, autonomous, and true AI coming to the consumer. The point here is that the enterprise build-out is not the end of the story. If AI capabilities move deeper into physical systems and consumer experiences, that expands the total addressable market again. So he is stacking catalysts. First, enterprise adoption broadens. Second, monetization becomes visible. Third, new categories like robotics and autonomy push the narrative even further. Then the interview shifts to Nvidia, and this is where Dan basically goes into his most confident mode. The interviewer references the idea that Nvidia looks cheap relative to where it has been, around 25 times forward earnings, and asks if it is a bargain. Dan's response is essentially yes, and he frames Nvidia as the one chip in the world fueling the AI revolution. That is classic Dan Ives language. He is saying there is one dominant supplier in the critical bottleneck layer, and that supplier still has pricing power and technology leadership. He calls Jensen Huang the godfather of AI. That is not just fanboy talk, it is branding Nvidia as the central platform leader. In market narratives, leaders get premium multiples, and they also tend to capture the early profit pools. Dan also says investors are not factoring in what happens in China market as they get further into that. Without getting into details outside this interview, the concept he is pointing at is optionality. He is saying there is upside that is not fully modeled in. He also says Nvidia is playing a different game and is 4 to 5 years ahead. That is the moat argument. If you believe they are multiple years ahead, then you assume competitors cannot catch up quickly, and you assume Nvidia can keep iterating its platform while the market grows. That creates a powerful bull case for multi-year compounding. The transcript includes a line that looks like a price target range, something like 250 to 275. The exact wording is messy, but he is clearly signaling he sees meaningful upside from current levels, and he expects a massive 2026. Then he says numbers are going to dictate it, which is his way of saying, this is not just sentiment, earnings power will justify it. And the final investor takeaway is his comment about sell-offs being golden buying opportunities. That tells you his stance on volatility. He is not scared of pullbacks. He views them as entry points because he thinks the secular trend is stronger than the temporary market mood. Finally, they ask the portfolio construction question that a lot of people are debating. Is 2026 an index year, where you just buy the QQQs and ride the wave, or is it a stock picker's market? Dan says it is going to be a great year for tech overall because the second, third, and fourth derivatives across AI are playing out. That phrase, derivatives, is important. He is talking about the ripple effects. First order is chips and cloud. Second order is software platforms. Third order is infrastructure and services. Fourth order is the broader economy productivity layer and new categories. He is basically saying AI is spreading across the stack. But even with that bullish view, he says winners and losers. That is the key. He is saying you cannot just own tech as a concept and expect equal outcomes. You have to be intentional. Who do you own in software? Who do you own in semis? He mentions Micron and memory players, and he also references infrastructure names. That is him telling you the AI trade is not just one stock, it is an ecosystem. Different parts of the ecosystem will have different timing. Chips lead early. Memory and networking benefit as compute scales. Cloud benefits as workloads move. Software benefits as enterprises operationalize AI. And, within each layer, execution matters. He references their AI 30 as part of their thesis, which sounds like a basket approach where they have curated the perceived winners. The reason that matters is, it reinforces his philosophy. He is bullish on the trend, but selective on the vehicles. That is a very different message from, buy the index and forget it. It is basically, the tide is rising, but you still want the best ships. So if I boil down his entire interview into the simplest interpretation, Dan Ives is saying this: the market is currently caught up in valuation anxiety and short-term turbulence, but enterprise AI is still early. Demand for compute is still far ahead of supply, and the next 12 to 24 months are likely to be defined by upward estimate revisions, visible monetization, and clear separation between the winners that execute and the losers that fall behind. Microsoft, in his mind, is being underestimated because Azure and Copilot are going to be more central to enterprise workflows than investors are currently modeling. Nvidia, in his mind, remains the core pick and shovel for the entire AI build-out, with leadership that he believes is not being fully valued during pullbacks. And across the sector, he is warning that 2026 will reward focus, not laziness, because the dispersion between leaders and laggards is going to be real. Now, whether you agree with his exact targets or not, the value in listening to Dan here is understanding how he is mapping the cycle. He is not talking about AI as a story. He is talking about AI as an adoption curve that is still in the early stages, moving toward a monetization phase, and then expanding into new categories. If that sequence plays out, his view is that the market is going to have to reprice the leaders higher, and the best opportunities may show up precisely when the headlines feel the worst and the market is the most nervous. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's dive into the 3 energy growth stocks to buy now for 2026. First up is Valero Energy, ticker VLO. If you've ever filled up at a Valero station, you might not realize you're dealing with one of the most innovative and forward-thinking companies in the energy sector. Valero is a name that's been synonymous with refining for decades, but today, it's quietly transforming itself into something much bigger. Valero isn't your typical refiner. They're rapidly becoming a leader in renewable fuels, a move the market is still underestimating. While most investors see Valero as just another oil refiner, the company is making bold moves into renewables, positioning itself at the forefront of the energy transition. This isn't just a side project, it's a core part of their long-term strategy. With one of the largest, most efficient refining systems in the Western Hemisphere, Valero is leveraging its infrastructure to dominate renewable diesel. Their vast network of refineries and pipelines gives them a scale advantage that few can match, allowing them to quickly adapt to changing market demands and regulatory pressures. Renewable diesel is a high-quality drop-in fuel that's set for surging demand as emission standards tighten. Unlike traditional biodiesel, renewable diesel can be used in existing engines without modification, making it a game-changer for fleets and consumers alike. As governments around the world push for cleaner fuels, the demand for renewable diesel is expected to skyrocket. Through its Diamond Green Diesel joint venture, Valero is already a top global producer and is expanding fast. This partnership has allowed Valero to scale up production rapidly, and with new facilities coming online, their capacity is set to grow even further. Diamond Green Diesel is now one of the largest renewable diesel producers in the world, and Valero's stake in this venture is a major growth engine. Their strategy is simple but powerful: use the cash cow of traditional refining to fund explosive growth in renewables. By reinvesting profits from their core business, Valero is able to finance new projects without taking on excessive debt, ensuring both stability and growth. This self-funding model is a key reason why Valero stands out among its peers. This dual approach gives Valero both stability and a high-growth engine, rare in the energy sector. While many competitors are forced to choose between legacy operations and new technologies, Valero is proving it's possible to do both, and do them well. This balance is what makes Valero such a compelling investment story. Operational efficiency is Valero's hallmark. They run at high utilization rates, squeezing maximum profit from every barrel. Their focus on cost control and process optimization means they can weather downturns better than most, and capitalize quickly when markets recover. Now, they're applying that same discipline to renewables, aiming to be the lowest cost producer. By leveraging their expertise in refining, Valero is driving down the cost of renewable diesel production, making it more competitive with traditional fuels and ensuring strong margins as the market grows. This cost advantage creates a deep economic moat, making it tough for competitors to catch up. In an industry where scale and efficiency matter, Valero's head start in renewables gives it a durable edge that should last for years. Valero's adaptability is key. They shift production as markets change, ramping up renewables as mandates increase. This flexibility allows them to capture new opportunities and minimize risk, no matter how the energy landscape evolves. By 2026, I expect renewables to be a major part of their business, forcing Wall Street to re-rate the stock. As the market wakes up to Valero's transformation, the company's valuation could see a significant boost, rewarding early investors. Right now, Valero is still valued like a traditional refiner, but as renewables grow, a higher multiple is inevitable. The market often lags behind reality, and Valero's shift toward renewables is a classic case of hidden value waiting to be unlocked. The company's balance sheet is strong, with cash flows funding debt reduction, buybacks, and growth projects. This financial discipline means Valero can invest in the future while still rewarding shareholders today. For investors, this means a stable dividend and significant upside as the market catches on. Valero's commitment to returning capital to shareholders is unwavering, and as earnings grow, so too does the potential for dividend increases and share price appreciation. Valero's resilience was clear during recent volatility. They thrived while others struggled. When oil prices swung wildly and many competitors faltered, Valero's operational excellence and diversified approach allowed it to maintain profitability and even expand its market share. Their all-of-the-above energy strategy positions them to profit from both traditional and renewable fuels. Whether the world moves quickly toward renewables or takes a more gradual path, Valero is set to benefit from both sides of the energy equation. Each new renewable diesel project is a catalyst, adding to the bottom line and drawing investor attention. As these projects come online, they not only boost earnings but also signal to the market that Valero is serious about leading the energy transition. The dividend is attractive and growing, rewarding patient investors as the growth story unfolds. Over time, those who stick with Valero are likely to see both income and capital gains, making it a compelling choice for long-term portfolios. In summary, Valero is a dominant market leader, a hidden growth story in renewables, and a disciplined management team, all at a reasonable valuation. The leadership team's vision and execution have positioned the company to thrive in a rapidly changing industry. This is a textbook growth at a reasonable price play. For investors seeking both stability and upside, Valero offers a rare combination that's hard to find elsewhere in the energy sector. The real opportunity is getting in before the market fully recognizes the transformation. As more analysts and investors catch on, the window for outsized gains could close quickly. Valero's combination of refining strength and green energy push makes it a top pick for 2026. If you're looking for a company that's not just surviving the energy transition, but thriving because of it, Valero deserves a spot on your watch list. Keep a close eye on VLO. The next few years could be transformative, and those who act early stand to benefit the most. Let's move to our next energy giant. Next up is Cenovus Energy, ticker symbol CVE, a Canadian integrated energy company that's quietly positioning itself for a major breakout in the coming years. While it may not always grab headlines like some of its larger global peers, Cenovus is building a reputation as one of the most disciplined and forward-thinking players in the energy sector. What sets Cenovus apart is its fully integrated business model. The company operates across the entire value chain, from extracting oil sands deep in the heart of Alberta, to refining crude oil into finished products like gasoline and diesel. This vertical integration gives Cenovus a significant edge, allowing it to capture value at every stage and weather the ups and downs of commodity markets more effectively than pure-play producers. At the core of Cenovus's operations is a relentless focus on technology and efficiency. Their use of advanced techniques like steam-assisted gravity drainage, or SAGD, has dramatically lowered production costs and reduced the environmental footprint of oil sands extraction. This isn't just about squeezing out a few extra dollars, it's about making oil sands production viable and sustainable for the long term, even as the world transitions to lower carbon energy sources. The real game changer for Cenovus came with its acquisition of Husky Energy. This bold move didn't just add scale, it transformed Cenovus into a true integrated powerhouse, with a balanced portfolio of upstream production, downstream refining, and retail operations. The combined company now has the flexibility to optimize its operations and maximize profitability, regardless of where oil prices are headed. With this integration, Cenovus can now capture the full margin from the wellhead all the way to the gas pump. This means more stable and predictable cash flow, even in volatile markets. It's a model that's proven its worth time and again, especially during periods of price swings when pure producers or refiners can struggle. Financial discipline is at the heart of Cenovus's strategy. The company's top priority has been to strengthen its balance sheet, and it's making rapid progress on paying down debt. This focus on deleveraging is unlocking free cash flow, which can then be returned to shareholders or reinvested in high-return projects. Once Cenovus hits its debt targets, management has made it clear that shareholders will be rewarded. Expect to see aggressive share buybacks and meaningful dividend increases, direct tangible benefits for investors who stick with the company through this transformation. Transparency is another hallmark of Cenovus's approach. The management team regularly communicates its capital allocation plans and progress, giving investors a clear line of sight into how value will be created and returned. This openness builds trust and sets Cenovus apart from less communicative peers. But Cenovus isn't just about financial returns. The company's also a leader in sustainability. Having co-founded the Oil Sands Pathways to Net Zero Alliance, this ambitious initiative brings together major industry players to collaborate on reducing greenhouse gas emissions from oil sands operations, with the goal of reaching net zero by 2050. Cenovus is putting real money behind its environmental commitments, investing billions in carbon capture, utilization, and storage, as well as other emissions-reducing technologies. These aren't just box-ticking exercises, they're strategic investments that will help future-proof the business as global energy markets evolve. As these efforts bear fruit, Cenovus is poised to enhance its reputation and attract a broader base of institutional investors. By 2026, the company could be seen as a benchmark for responsible energy production, both in Canada and globally. Despite all these strengths, Cenovus stock still trades at a discount to many of its global peers. This undervaluation presents a compelling opportunity for investors, as the gap is likely to close as the company continues to deliver on its promises, and the market recognizes its progress. One of Cenovus's biggest advantages is its portfolio of long-life, low-decline oil sands assets. These resources provide a steady base of production and generate high free cash flow year after year, supporting both growth and shareholder returns. The integrated model also acts as a natural hedge against commodity price swings. When oil prices fall, Cenovus's refining operations often benefit from lower feedstock costs, helping to offset the impact and keep cash flow resilient. Growth at Cenovus is focused and capital efficient. Rather than chasing risky mega projects, the company is investing in targeted expansions and debottlenecking projects that deliver strong returns without stretching the balance sheet. The management team has a proven track record of setting ambitious targets and consistently delivering on them. This reliability has built a strong foundation of trust with investors who know they can count on Cenovus to execute its strategy. With operational leadership, a stable and diversified asset base, and a massive capital return program in the works, Cenovus is well positioned to deliver value in multiple ways. By 2026, expect to see a leaner, more efficient company with fewer shares outstanding, a rock-solid balance sheet, and a reputation for both operational excellence and sustainability leadership. For investors, Cenovus offers a rare combination of value, growth, and income potential. It's a balanced package that's hard to find in today's market, especially in the energy sector. The story here is refreshingly simple. Deleverage the balance sheet, generate robust cash flow, and return that cash to shareholders through buybacks and dividends. It's a straightforward formula, but one that's proven to create lasting value. For those looking to play the energy sector over the next few years, Cenovus stands out as one of the best-positioned companies, offering both upside potential and downside protection. Now, let's dive deeper into the technology driving the next phase of the energy boom, and see how companies like Cenovus are leading the way. Our final pick is TechnipFMC, ticker FTI, the technology and services backbone of the energy industry. This is a company that sits at the intersection of innovation and necessity, quietly powering the world's most ambitious energy projects. If you're looking for a business that's not just keeping up with the times but actively shaping the future of energy, TechnipFMC is a name you need to know. TechnipFMC leads in subsea and surface technologies, handling everything from deepwater extraction to land-based shale operations. Their technology enables oil and gas companies to reach resources that were once thought impossible to access, making them a critical partner for both established giants and emerging players in the sector. Their expertise is critical for massive, complex energy projects worldwide. Whether it's a sprawling offshore platform in the North Sea or a high-tech shale operation in the US, TechnipFMC's solutions are the glue that holds these projects together, ensuring safety, efficiency, and reliability at every stage. What's exciting now is the start of a new investment cycle. Energy companies are greenlighting big projects again. After years of underinvestment, the industry is ramping up, and TechnipFMC is right at the center of this resurgence, benefiting from a wave of new approvals and capital commitments. TechnipFMC is seeing a surge in multi-year contracts, providing strong revenue visibility through 2026. These aren't just small deals. These are multi-billion-dollar projects that span continents and require years of planning and execution, locking in predictable cash flows for the company. This is the early stage of a multi-year upcycle, and TechnipFMC is set to capture a big share. As the industry's needs grow more complex, their ability to deliver integrated solutions puts them in a prime position to win even more business. They're not just about oil and gas, they're moving into carbon capture, green hydrogen, and offshore wind. These new frontiers are essential for the global energy transition, and TechnipFMC is leveraging its decades of experience to help build the infrastructure of tomorrow. Their engineering skills transfer seamlessly to new energy markets, positioning them for long-term growth. The same expertise that made them leaders in oil and gas is now being applied to renewables, giving them a unique edge as the world diversifies its energy mix. By 2026, new energy ventures should be a significant part of their business, attracting new investors. As more capital flows into sustainable energy, TechnipFMC's early moves into these sectors could pay off in a big way, making them a magnet for ESG-focused funds and forward-thinking shareholders. Their iEPCI-TM model, integrated project management, gives them a huge edge, simplifying projects and locking in higher margins. By offering a one-stop solution from concept to completion, TechnipFMC reduces risk for clients and captures more value for itself. This approach builds deep client relationships and cements their leadership. Clients trust TechnipFMC not just as a contractor, but as a strategic partner who can deliver on time, on budget, and with the latest technology. Financially, TechnipFMC is focused, high margin, and generating strong free cash flow. Their disciplined approach to capital allocation means they're not just growing, but growing profitably, with a clear path to even higher returns as the cycle matures. As revenues grow, profits should accelerate thanks to operating leverage. The company's fixed cost base means that every new project adds more to the bottom line, creating a powerful engine for earnings growth. The market is starting to notice, but the full upcycle potential isn't priced in yet. For investors, that means there's still time to get in before the story is fully reflected in the stock price. Global reach is another strength. Demand is rising worldwide, especially in developing regions. As countries modernize and energy needs soar, TechnipFMC's international footprint ensures they're part of the action wherever growth is happening. Their technology moat, from all-electric subsea systems to digital tools, keeps them ahead of competitors. They're constantly innovating, investing in R&D to stay at the forefront of efficiency, safety, and environmental performance. Investing in TechnipFMC means betting on the world's need for energy infrastructure, traditional and new. As the energy landscape evolves, their ability to bridge old and new technologies makes them indispensable. By 2026, they'll be executing a huge backlog, with higher revenues and a bigger role in the new energy economy. Their project pipeline is robust, and their execution track record gives confidence that these projects will translate into real, tangible results. This is the most direct way to play the coming capital spending boom in energy. As governments and companies pour money into infrastructure, TechnipFMC stands to benefit more than almost anyone else in the sector. While producers ride oil price swings, TechnipFMC's fortunes are tied to long-term project activity. This means less volatility and more predictability, making it a safer way to gain exposure to the energy sector's upside. The risk-reward is compelling. Strong backlog limits downside, while the upcycle offers major upside. For investors, this combination of stability and growth potential is rare, especially in such a dynamic industry. For tech-focused energy exposure, TechnipFMC is best in class. Their relentless focus on innovation ensures they'll remain a leader as the industry evolves, and their solutions are setting new standards for what's possible in energy. The catalysts are clear, the valuation is reasonable, and the growth story is compelling. With a strong balance sheet, a world-class team, and a strategy built for the future, TechnipFMC is positioned to deliver for years to come. FTI deserves a spot on your watch list. If you're looking for a company that combines technology, scale, and a forward-looking vision, this is one to watch closely as the energy transition accelerates. Let's wrap up with some final thoughts. TechnipFMC is more than just an energy services company. It's a technology powerhouse, a global operator, and a key player in the world's energy future. As the industry transforms, TechnipFMC is set to lead the way, making it a standout pick for investors who want to fuel their portfolios for the next decade and beyond. There you have it. 3 powerful ways to invest in the future of energy. Valero is transforming refining with renewables, Cenovus is set to unleash cash to shareholders, and TechnipFMC is the tech backbone of the industry. The energy sector is full of innovation and opportunity for long-term growth. These aren't short-term trades, they're investments in well-managed companies with clear catalysts for the next few years. Which trend do you think has the most explosive growth potential by 2026? Let me know in the comments. Don't forget to like, subscribe, and share your thoughts below. Thanks for watching, and I'll see you in the next one. Stay tuned for more deep dives on the biggest opportunities in investing.